Welcome to Fed Watching for the week of December 17th through 21st. It was a wild one. Things got hammered, and we'll have a longer than usual economics section this week to break down the FOMC speech from Jay Powell. So let's just jump right into it and see what it was like at the time. It's Monday, December 17th. The markets took a nasty little tumble, down 2%. Another down day. It was no Santa Claus rally coming this year, it looks like. Best part is we got year end when people normally do their predictions coming right around the same time as the market going down. So are people going to predict 2019's a big down year? Are they going to predict that we get a big bounce back? Are people going to make predictions tomorrow that they're going to have to walk back a week from now? It's going to be fascinating. It's going to be a good time. And we will see when we get the FOMC meeting, if the Fed doesn't raise rates, I think we might see a huge day. Might see a 3 or 4% day for the stock market because it seems like they're really building that in. The other big X factor is China. Who knows how much it's moving on China and how much it's just moving, and China's the easy thing to write about. But we'll see. We'll see tomorrow, Wednesday, Thursday, Friday, how things are shaping up going into the holidays. It's Tuesday, and the market started up but ultimately ended flat today. And, of course, when we're looking at markets, I want to decide if they're slightly up or flat. First, we're going to look at the S&P 500. That one's flat. Even if the Dow's slightly up or down, we're going with flat. Big thing everyone's waiting for is tomorrow's FOMC meeting, where we might get a rate hike, we might not. A little bonus for you today. We got the FOMC rate hike probabilities. So futures market, CME has it at about a 30% chance that we get no hike and about a 70% chance that we get a hike. Not a big change from what people have been expecting. Say, if I had to be a betting man, I would like the odds on the no rate hike. I think still greater than a 50% chance we do get the hike, but I'd handicap it closer to 55 or 60 than 70%. Seems like all the Fed FOMC members and even the ones that aren't on the Open Markets Committee have been hedging a lot towards being willing to not move rates. I don't think Trump telling them not to move rates or to read the Wall Street Journal editorial page before they do is going to change their decisions one way or another. If anything, I think it might hurt their cause. They might think it's better for their credibility if they just go ahead and raise rates and then not raise them in the future, so they avoid looking like they're in organ of the federal government. But we'll see. We'll see tomorrow. I think we'll get a big up day if they don't raise rates. And if they do, I think it's mostly baked in. I think flat to slightly down would be expected, would be normal. But we will see. It's Wednesday. Fed hiked. There's blood in the streets. Oh, no, just down 1.5%. Not blood in the streets. Never mind. We are down to levels that we haven't seen since checks notes September 2017. So we're down over 15 months, which happens all the time. It's Thursday, and markets were down again. S&P was down 1.5%, about the same for the NASDAQ, and the NASDAQ is now down 20% from its highs. So technically the NASDAQ is in a bear market. I don't know when we started referring to specific indices as being in a bear market rather than the whole market, but here we are. We're doing it. There wasn't really a lot of news today. Economic news, weekly jobless claims were strong, were relatively low. Leading economic indicators were pretty good. It seems like maybe the market just took a minute to decide what it thought about the interest rate hikes. Hard to say. It's kind of interesting to see people talking about, we got this quantitative tightening. That's the next big thing people are focusing a lot and saying that the Fed letting, this is basically the opposite of quantitative easing. The Fed doing this quantitative tightening is bad for the market. So I give you this beauty from Mike Bird. Quantitative easing didn't do anything. Quantitative tightening is damaging the market. It certainly wasn't both. I think quantitative tightening definitely will be something where just because Fed funds rate isn't rising, if they are tightening, it will make a difference. I'm one of those people that thinks quantitative easing definitely did do something. But we'll see. It's not like the Fed doesn't control the quantitative tightening. It's not like they don't know how much they're doing, and should be pretty easy to correct for. So probably no big deal. We'll see how we end the week tomorrow. It's Friday, and it's another down day. S&P 500 down 2%, Nasdaq's down 3%. Nasdaq's bear market territory down more than 20% from the highs. S&P 500's down about 17%, which and it's 17% for the quarter. That is right now the sixth worst quarter in market history, according to @OddStats. And the other three of them were from the Great Depression. One of them was had Black Monday in it in 1987, and there was another quarter in 2008, quarter four of 2008 actually, where we were down 22.6%. So not quite as bad as those, but this quarter has been pretty bad. There you have it, absolute doozy of a week. We had one flat day, 2 days down just about 1.5%, and 2 days down 2%. So the S&P 500 is down 7% for the week. Just felt like we kept getting hammered. There wasn't really a whole lot of news. Trade war was in the wind most of the time. Of course, the Fed raised rates, but really it just felt like things were going down because they were going down. There wasn't a whole lot of things that you could point to and say, this is the reason, of course, other than the Fed not raising rates, which shouldn't explain a whole week's worth of moves. So while Fed tightening makes sense that stocks would go down a little bit, that wasn't it entirely. Just a little bit of volatility. And I've got a nice little fact for you coming up here. So on Friday I misspoke. It was not the sixth worst quarter in market history. It was the sixth worst fourth quarter in market history, 16th worst quarter in market history. And right there, you can take a look at what exactly were the other quarters. You can see the 30s were absolutely crazy. And the very right-hand column, and this is all courtesy of OddStats on Twitter, my boy, thank you for the work. And he's looking at what are the next quarter returns. And you can see next quarters are mostly pretty green there. Again, the 30s were just crazy. So taking a look at how bad it was, of course, down quarters in the high teens, the low 20s, they do happen. It's just something that it's the price of entry. So anyone that's saying, hey, we're running for the hills here, you look at those green numbers, especially those 15, 30, 80% green numbers. It's hard to think that's the right thing to do, but it's scary to see a big down quarter, especially if you think maybe one of the down 10, down 20s is going to be what's coming next. On to the economics. So all the numbers that I saw were just what we've been talking about these last few weeks and months, where things were good, strong. Some of them were a little better than they had been the week or the month before, some a little worse, but really the market's still doing very well. What I'm going to give you is a summary of Jay Powell's press conference that I listened to, so you don't have to. And his prepared remarks, he talked about we got low unemployment and low inflation. We are starting to see some weakness in the rest of the world, especially compared to September. And lower Fed funds rate going forward than expected in September. We haven't had as much inflation as they expected in September. We've had more weaknesses in the markets than he expected since September. So things have moved a bit. They've raised their target range for the Fed funds rate a quarter point. That was what just happened at this press conference. And we are now more likely to see 2 increases in 2019, not 3 or more. Then he went back and compared it to pre-2018. So right before 2018 started, we were at 4.1% unemployment and 2.1% inflation. We got 4 rate hikes in 2018. And a lot of the reason behind that, he said, was because fiscal policy was very front-end loaded in 2018. That mostly means the tax cuts. 2018 was a hotter year than expected as far as the economy. We'll see if that continues. He said, and this I think was a big deal that we haven't heard enough on. He said we're in the neutral range for rates right now. He said we're at whatever the lower end means, but he thinks we're neutral right now. So we won't necessarily see any more rate hikes if we start to see the indicators that they're looking at, especially the employment-related, inflation-related ones, trending in the wrong direction, in a bad direction. So higher unemployment and higher inflation. He got a bunch of questions, and a bunch of the questions were really good. So one of them was about balance sheet normalization. Yeah, he said, what's the deal? And this is, if you've seen it, what we talked about with the little cartoon and during one of the days. We had quantitative easing before, now this is quantitative tightening. He said they're going to let the balance sheet run off. That's still the plan. They're going to use rate policy as the active tool. They don't think it's a big deal. It's been a very small amount so far. Anyone that thinks quantitative tightening is what's behind this, he thinks is out of their minds, basically. He said that. Or he didn't say that. I did. He was asked about the market decline. He said he considered it. Of course, no one market is what he's looking at. He was asked about tariffs. He said they're very small effects. It would have to be something else, some other ramification that would cause big shifts in the numbers that they're looking at. He was asked about political considerations, and he basically said, again, my words, not his, we don't care at all about what Trump says. It's not going to affect us. We have all the authority and the independence. We need to do what we're going to do, regardless of what anyone says or tweets. He was asked, this is a really good question, you're about to undershoot inflation for a 7th straight year. WTF, mate? And he said, we have a symmetric goal, blah, blah, blah. We have a symmetric goal. I take that to me, and this is me reading between the lines, there are a lot of FOMC members who are very afraid of inflation, and this is the best we could do. That was how the answer felt to me, because when the question was asked, just the look on Jay's face was, I know, and there's not much I can do about it. That was how it felt. There was a follow-up on that, hey, why are you raising rates if that's the case? He said, with how healthy the economy has been this year and how healthy we think it's going to be next year, we think it was appropriate to raise rates. He was asked about core PCE, which is the inflation measure that the Fed uses, versus GDP growth as like a primary indicator for what they should use. He said he thinks core PCE inflation is still a very good indicator. He says it hasn't moved as much as the Fed would have expected given where we are in the labor cycle. But still, it's the thing they're going to look at. He was asked about the labor cycle and gave a pretty interesting answer that, yes, inflation is relatively low and unemployment is extremely low. But we're seeing not a lot of participation out of especially prime age males compared to historically. And if prime age males re-enter the labor force, and that could extend the cycle, that could mean we're not going to see higher unemployment, we might see lower. And then he was asked, the 10-year treasury is down about 50 basis points in the last few weeks. What do you think? He said, same thing as his answer about the stock market. We look, but we don't obsess about it. It's something that we consider, but it's only one of many markets. So that was the big news. We'll take a look, certainly in one of these next couple of weeks, what people are expecting for future rate hikes. But I think we're pretty unlikely to see one soon unless the market, the economy, inflation all kind of recover pretty quickly and pretty drastically. Just 2 links for you this week. I'll give you a link to Jay Powell's speech, because if that's something that you're interested in, if economics is something that you're curious about, there's no substitute for hearing it from the horse's mouth. And the other one is Cliff Asness from AQR had a great article called Once More Without Feeling. And he's talking about this isn't a very big deal. Using the S&P 500, this has been a 66th percentile year for volatility. So more volatility than 2 out of 3 years, but not much more than that. And then it's a 24th percentile year for returns. And this article came out in the middle of this week, so the numbers might have gotten a little more extreme since then, but it gives you a sense for the fact that this isn't that far out of the norm. This is what you should expect. People that have only been following markets for the last 5 or 10 years, people that aren't considering 2008 and well before that, are thinking this is crazy to see 1% and 2% moves all the time, but it's not that unusual. He thought the bigger surprise was a lack of any real strong asset classes. This has been down pretty much across the board. That is a little bit unusual. He thinks that should be more of the storyline. So find the link to that below. That's it for this week's episode of Fed Watching. Thank you very much for tuning in. And as always, give us a rating on iTunes. Give us a rating on Stitcher. Give us a like or a follow on YouTube. And again, if you're listening to this on a podcast and you want the video, there's a video. You'll be able to see the memes that come up on the screen. And if you prefer podcasts, you can always download it. So see you next week. Have a very Merry Christmas, Happy Holidays, and we'll talk before the new year.